As the North American markets are currently closed, Bitfarms Ltd ended its last trading session on October 14, 2025 at a remarkable $8.26 Canadian on the Toronto Stock Exchange, representing an explosive single-day gain of $2.40 or 40.96%. Now, a surge of that magnitude will immediately have most people pointing to a single culprit, the price of Bitcoin. But attributing this dramatic repricing solely to the underlying digital asset is the first and most common mistake an observer can make. The real story behind this move is far more nuanced, rooted in a calculated operational execution that the broader market is only now beginning to price in, separating Bitfarms from its less efficient peers in a way that simple crypto price correlation fails to capture. The widespread expectation for a stock like Bitfarms is that it functions as a high beta proxy for Bitcoin. It's a simple narrative that's easy to understand for anyone doing some self-investing on popular platforms. The logic follows that if Bitcoin rallies, miners who produce it will see their future revenues and current holdings increase in value, causing their stock to outperform the asset itself. Conversely, if Bitcoin falls, the miners should fall harder. This is the story that drives a significant amount of the volume, from day traders on the Robinhood app to those setting up their first SoFi investing account. The expectation is one of direct, amplified correlation, but reality is diverging from this script. While the correlation certainly exists, the degree of that correlation and the company's resilience during downturns are now being dictated by something far more important: operational efficiency and strategic power agreements. This is the data that more sophisticated investors, perhaps using the advanced tools on an interactive broker's trading platform, are focusing on. They see that not all miners are created equal, and the market is slowly waking up to this fact. Let's dissect the recent 40.96% rally. The trading volume accompanying this move was significantly higher than its daily average, suggesting a major influx of capital. While a portion of this was undoubtedly retail traders chasing the momentum, institutional order flow analysis shows a significant block of buying activity that wasn't present in previous more modest rallies. This indicates that larger funds, possibly those managing complex portfolios or even Fidelity ETFs, are beginning to build positions. Why now? Because Bitfarms has been quietly executing a fleet upgrade and expansion plan that has pushed its cost to mine a single Bitcoin well below the industry average. While competitors were struggling with financing and supply chain issues, Bitfarms was securing next-generation mining rigs and, more critically, locking in long-term, low-cost hydroelectric power contracts, particularly at its facilities in Quebec and its growing operations in Paraguay. This isn't just about making more when Bitcoin is high. It's about surviving and even thriving when prices are low or stagnant, a reality that the market seems to have ignored until this recent breakout forced it to pay attention. The difference in performance wasn't just against the broader market, which saw modest gains, but even against other crypto-related equities. It outpaced many of its direct competitors, suggesting this was a flight to quality within the sector, not just a broad speculative rush. It's a level of detail that requires more than a glance at a stock chart. It requires a deep look into corporate presentations and operational updates, a core principle of sound online investing. For those unfamiliar with the company's core operations, Bitfarms is a Bitcoin self-mining firm. In simple terms, it owns and operates large data centers filled with specialized computers, known as ASICs, that run complex calculations to secure the Bitcoin network. As a reward for this service, the network issues new Bitcoin to the miners. Bitfarms' entire business model revolves around doing this at scale and as cheaply as possible. The primary operating operating expense is electricity. Therefore, the company's entire strategy is built on finding and developing sites with access to abundant, cheap, and preferably sustainable energy sources. They currently have multiple farms in Canada, a site in Washington state, and are significantly expanding their presence in Paraguay, a country with a massive surplus of hydroelectric power. In the past, during crypto downturns, the company faced significant pressure as the price of Bitcoin fell close to or even below their cost of production. However, their recent focus on upgrading to more energy-efficient machines and securing industry-leading power rates changes that equation entirely. An investment in Bitfarms is no longer just a bet on Bitcoin's price, but a bet on the company's ability to maintain its position as a low-cost producer. This is a crucial distinction that separates it from just holding crypto directly through a platform like Robinhood Crypto. Managing an equity position like this within a larger portfolio, perhaps in an individual brokerage account with a provider like Fidelity, requires understanding these operational specifics. Looking ahead, the landscape for Bitcoin miners is filled with both immense opportunity and significant risk. The most discussed catalyst is the next Bitcoin halving event, anticipated in the coming year. The halving is a pre-programmed event that cuts the reward for mining a block in half, effectively slashing the revenue for all miners overnight. The common expectation is that this supply shock will lead to a significant increase in Bitcoin's price, benefiting all miners. However, the reality is far more brutal. The halving will be an extinction-level event for high-cost, inefficient miners. Those who cannot mine a Bitcoin for less than its market price will be forced to shut down. This is where Bitfarms' strategy could pay off handsomely. If they can maintain their position on the low end of the cost curve, the halving could eliminate a substantial portion of their competition, allowing them to gain a larger share of the network's hash rate and, by extension, a larger share of the remaining mining rewards. It's a scenario where the strong get stronger. Another potential tailwind is the continued institutional adoption of digital assets. As more sophisticated investment help services and even automated systems like Schwab Intelligent Portfolios begin to consider allocations to this space, companies like Bitfarms, with their public listings and transparent operations, stand to be primary beneficiaries. They offer a regulated, accessible way to gain exposure compared to direct asset ownership. Comment below what you believe Bitfarms' cost per coin mined will be post-halving. Do you think they can maintain their competitive edge? Of course, the risks remain substantial. The company's fate is still heavily tied to the volatile price of Bitcoin. A prolonged bear market would put immense pressure on its financials, regardless of its efficiency. Regulatory risk is also a constant threat. While they have diversified geographically, a hostile government action in any of their key operating regions could disrupt operations. Furthermore, there is the ever-present competition. The mining industry is an arms race, with all players constantly seeking cheaper power and more efficient hardware. Bitfarms must continue to innovate and execute flawlessly to maintain its advantage. For investors looking at this space through investing sites, it's critical to understand that this is not a stable blue-chip stock like Apple stock, or even a high-growth tech leader like Nvidia stock. The potential for massive gains, like the recent 40% surge, is matched by the potential for equally dramatic losses. This is why thorough research and risk management, perhaps using the tools available on a Fidelity trading platform or through SoFi, are absolutely essential. Any online investment in this sector must be approached with a clear understanding of the full spectrum of possible outcomes. In conclusion, the story of Bitfarms' recent performance is a perfect illustration of the tension between market expectation and operational reality. The expectation was a simple, leveraged ride on Bitcoin's coattails. The reality is a company that has been strategically positioning itself to become one of the most resilient and efficient operators in the entire mining sector. The 40% pop was not just noise, it was a signal that the market is finally recognizing that the ability to control costs is just as important, if not more so, than a rising price for the final product. While the link to Bitcoin's price will always be a dominant factor, the companies that will survive and generate long-term value in this industry will be the ones that master the complex art of turning electricity into profit, no matter the market weather. That is the deeper, more complex reality that investors must now consider. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thumbs up. Don't forget to like, comment, and share this video to support the channel.